Happy Monday, everybody. Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. It is going to be a big week, so let's jump in. After a 3-day-long weekend, China's markets opened Monday morning to a bloodbath. Hong Kong's Hang Seng plunged nearly 11% at opening. The Hang Seng Technology Index dropped over 14%. The mainland's China CSI 300 dropped over 5%. Technology giants Alibaba and Tencent led the losses, each falling more than 11%. The sell-off sent China's benchmark 10-year bond yield down 8 basis points, approaching a record low as investors fled to safer assets. Of course, the market was reacting to escalating trade tensions with the United States following a fresh round of tariffs and retaliatory measures from Beijing on Friday. Market sentiment was further rattled after the People's Bank of China set the renminbi at the weakest level in over 4 months, signaling possible tolerance for currency depreciation. The timing following Friday's grave sweeping festival market holiday gave investors their first opportunity to digest Beijing's swift retaliation to Washington's tariffs. Quote, "This is taking us further into a trade war," warned Shane Oliver, chief economist at AMP Limited, as fears grow that further tariff escalations could damage the global economy. Selling pressure was widespread, with every stock in the Hang Seng China Enterprise Index trading lower. Xiaomi and Meituan were among the biggest drags. The sell-off also dimmed hopes of a continued rally driven by China's AI progress, which had lifted the MSCI China Index by 13% year-to-date before Friday. Some analysts see opportunity amid the chaos, however. Kenny Wen of KGI Asia believes retail investors may begin, quote, "buying the dip," end quote, later in the week, encouraged by potential government support. China's state-run People's Daily emphasized the country's readiness to ease monetary policy and expand fiscal stimulus to cushion economic shocks. Bond demand surged as concerns grew over China's fragile economy. Some analysts, including those at Wells Fargo and Jefferies, speculated China could devalue the yuan by up to 30% to counteract tariffs. That would be quite the tiger for Chinese policymakers to ride, however. Depreciating the yuan carries significant risks of massive capital outflows, as Chinese investors, even though they face a very tight capital control at the border, would try to get their money out of the country. Xin Yaoying, a fund manager at Aberdeen Investments, observed on Sunday, quote, "It will be an ugly start on Monday, which will be a buying opportunity for me. Some estimates suggest tariff wars can bring down China's GDP growth by 2 percentage points, but the government will negate that pain with stimulus and trade deals with non-US countries in the due course." End quote. That may be the case, but Beijing will likely find it very difficult to replace America's consumer market, and while stimulus is likely very possible, indeed it's probable, as we've discussed before, that will mean more surging, unsustainable debt. Whether this is a buying opportunity or not, uncertainty reigns as markets brace for the next move in an increasingly unpredictable trade standoff. Meanwhile, authorities are investigating Liu Tianran, the son of former Vice Premier Liu He, in a widening anti-corruption campaign targeting the financial sector. Liu He, once a close confidant of Xi Jinping and China's economic chief, played a key role in negotiating trade deals with the United States during the first Trump administration. Liu Tianran, considered a Princeling due to his political lineage, founded investment firm Skykis Capital in 2016 and served as its first chair. According to several reports citing people unnamed that are familiar with the situation, he is now under investigation, with some sources suggesting he has already been detained. The probe reportedly centers on suspected financial corruption. Authorities first scrutinized Liu in connection with the halted $37 billion IPO of Ant Group, a deal once poised to be the world's largest. During the inquiry, unrelated corruption cases allegedly emerged, prompting Xi Jinping to receive a report on the findings. This investigation reflects a broader clampdown by the General Secretary, who has tightened oversight of China's finance industry, slashed bankers' pay, and detained several high-profile investors. Experts believe the situation may also impact Liu He, whose political influence has diminished since his 2023 retirement, leaving him unable to shield his son. Next up, the United States has regained its position in Southeast Asia's preferred superpower, according to the State of Southeast Asia 2025 survey by the ISEAS Yusof Ishak Institute, published a few days ago. Conducted between January 3rd and February 15th, so notably before the latest round of tariffs kicked in, the survey shows that 53.3% of respondents across the region would choose to align with the United States over China if forced to pick sides, a notable shift from last year when 50.5% favored China. The reversal appears to reflect growing apprehension over China's assertiveness, particularly in the South China Sea. More than half, 51.6% of those surveyed, ranked aggressive Chinese behavior in the disputed waters as their top geopolitical concern. Other major anxieties included global scam operations, 48%, the uncertainties of new US leadership, 46.9%, and incursions into the exclusive economic zones of Asian states, 48.2%. While China still leads in perceived economic, 56%, and political strategic, 37% influence in the region, these numbers reflect a modest decline. Despite scoring highest in strategic relevance to ASEAN among dialogue partners, with a mean score of 8.8 versus 8.76 for the US, the weight of China's influence is increasingly seen as more threat than advantage. Notably, the survey preceded the latest round of US tariffs affecting every Southeast Asian country. Should such economic pressure continue, regional sentiment towards the US may cool. Some critics argue that the Trump administration missed an opportunity to narrowly target Chinese origin goods, opting instead for broad strokes that risk alienating key Association of Southeast Asian nation partners. Now today on my other channel, Market Update, we actually explore Southeast Asia's reaction to these tariffs from the United States. Indeed, it seems that many of them, unlike the Europeans who want to push back, are willing to negotiate a deal with Washington. That video went up about an hour ago. I left a link to that video in the description below. It also explores the general global meltdown we're seeing in financial markets. It's a big episode, and I would recommend it to anyone who is interested in following this space. If you enjoyed today's episode of China Update, don't forget to hit the like button, subscribe, and if you want to support the channel, Patreon and Buy Me a Coffee links are in the description below. Meanwhile, a recent panel hosted by the Asia Society Policy Institute Center for China Analysis, CCA, delved into the issue of global public opinion on China. Drawing on nearly 2,500 surveys collected by the Global Public Opinion on China GPOC project, the panel highlighted the rapid growth in global polling data. While just over 500 relevant surveys were conducted between 2000 and 2009, that number more than doubled in the 2010s and has already surpassed 850 in the first half of the 2020s. One key trend found across these surveys was the sharp drop in China's global favorability during the COVID-19 pandemic. While a decline in the industrialized West was already well documented, the data reveals a significant 10-point average decline in net favorability even in parts of the global South between 2019 and 2020. Regions like Latin America and South Asia experienced especially notable downturns in public sentiment. However, China's image remained relatively stable in the Middle East and Africa, and even showed signs of improvement in Southeast Asia, suggesting regional variations in how the pandemic affected perceptions. The panel argues that the data dispels some common assumptions as well. For example, in sub-Saharan Africa, favorable public opinion of China is not just the result of elite diplomacy or state-level engagement. Across nearly 300 surveys, public support for China consistently outweighs negative views by a ratio of about 3-1. This suggests genuine grassroots appeal, likely influenced by China's infrastructure investments and visibility in the region. However, the global South is far from monolithic. In countries like India, Turkey, and Iran, public sentiment remains largely negative, shaped by regional rivalries, historical tensions, and competing strategic interests. The panelists also discussed how China itself is increasingly concerned with its international image. The Chinese Communist Party, government elites, and media actors have become more sensitive to global public opinion, aware that their country's reputation can impact everything from trade relations to diplomatic negotiations. This self-awareness is reflected in Beijing's efforts to shape narratives through global media, education exchanges, and development aid, areas we have followed very closely on China Update these last few years. Ultimately, the panel highlighted the global perceptions of China are dynamic and multi-faced. These views are not only shaped by China's actions abroad, but also how other nations interpret and respond to these actions. As the strategic competition between the US and China intensifies, understanding public opinion could offer critical insight into the evolving global order and into how both powers might seek to influence it in the years ahead. Okay, that is today's episode of China Update, the first of what will likely be a very big week. I hope you enjoyed it. Thank you so much, everybody, for watching. Have a good Monday, and I will see you all tomorrow.